Good morning. This is Bloomberg Daybreak Europe. Happy Monday. I'm Tom McKenzie in London. These are the stories that set your agenda. US and European futures plummet. The dollar surges after President Donald Trump imposes tariffs on Canada, Mexico and China, threatening to upend global trade. Canada and Mexico vowed to hit back with countermeasures. Beijing is reportedly preparing a US trade proposal to avoid further tariffs. And the euro slides as Donald Trump says the EU is next, threatening tariffs very soon. So the clock is kicking down to those US tariffs, kicking in, of course, Tuesday, US time. The tariff teardown is there. This is the market reaction. Futures set for a battering here in Europe, pointing lower by 2.4%. We look at the automakers, we look at the miners, the impact on Europe, particularly the pledge from Trump that European tariffs are coming next. FTSE 100 futures pointing lower by 1.2%. Keep an eye on the metals. Keep an eye on Dr. Copper. That is falling deeply in the session today. Currently, S&P futures stateside looking to drop 1.9%. NASDAQ 100 futures looking to fall 514 points, down 2.4%. Let's flip the board and have a look cross-asset. You have yields up at the front end, yields down at the back end of the Treasury curve, reacting to the imposition of 25% on Mexico, Canada, and then 10%, of course, on China. Euro dollar at 102. The euro is being hammered. The dollar is surging, down 1.2% for the single currency. The 2-year, this is the selling pressure right now at the front end. 424 right now on the 2-year, yields up 4 basis points. It's a very different picture as you push out to the 10s and the 30s. NYMEX crude diverging from Brent, and that is significant right now. Currently, you're looking at a jump of 1.9%, $73, close to $74 on WTI. Bitcoin and Ether also taking a hammering in the session, 94,000. Bitcoin and crypto as a safe haven. That argument has been trashed in the session today. Bitcoin down 3%. Let's check in on the Canadian dollar, falling to the lowest level since 2003. The Mexican peso, and, of course, offshore, the Chinese yuan. The Mexican peso then down 2.3% versus the US dollar. The Canadian dollar down 1.3%. Canada says it will retaliate. Mexico says it will do the same. China working off potentially on a proposal to try to appease Donald Trump. Currently, the offshore yuan down 0.3%. Let's cross over right now to Avril Hong for the Asian market reaction. Standing by in Singapore. Avril.
Yeah, Tom, we're seeing very heavy selling, risk off in the region. The investor concern is rippling through that this is going to be an all-out trade war. Now that we've got the opening salvo from Trump on tariffs, you talked about Canada's retaliation, still waiting to hear what China does. But in the meantime, I thought it worth highlighting that we're seeing some of the AI movers as well. TSMC playing catch down. That's the drag on the Taiwan markets as they're back from the long holiday, part of that deep-seek selling. But Alibaba, interestingly, 5-6% higher today, helping the Hang Seng to cap declines. And this is amid optimism of its AI models, but also worth highlighting when it comes to Hong Kong markets that they're not performing as badly as some of the other parts of the region. Maybe this idea that with the announcement of tariffs, this opens the way for Chinese authorities to bring out the big bazooka on stimulus, flip the board. I wanted to highlight what we're seeing on the offshore yuan a bit more, on building on what you just talked about. When it comes to the trade war, as in the first iteration, the renminbi was where we really saw it, getting hit hard. Today, after the announcement, we actually saw offshore renminbi moving towards record lows. But it's interesting how it's not the worst performer among the Asia currencies. Maybe a bit of stealth intervention already underway. For the PBOC's official line, we'll have to wait until Wednesday when we get the fix, when onshore markets come back to trade. In the meantime, we have Wall Street Journal reporting that China is looking at talks with Trump on trade and that it's going to renew its pledge not to devalue the yuan to boost exports. So that's helping the renminbi offshore to pair some of the earlier declines, Tom.
Avril Hong in Singapore with a check on the Asian markets. The reaction there, of course, to the tariff story. The details right now. Canada and Mexico vowing then to hit back at the US after President Trump followed through on threats to impose 25% tariffs on imports of their goods. Beijing has promised corresponding countermeasures, as Avril was saying, to Trump's 10% levy on Chinese products without immediately announcing any new tariffs. Canada's Justin Trudeau says Trump's move left his government with no choice but to respond with counter tariffs.
First, I want to speak directly to Americans, our closest friends and neighbors. This is a choice that, yes, will harm Canadians, but beyond that, it will have real consequences for you, the American people.
Let's bring in opening trade anchor Kriti Gupta for the details. Kriti, what does this impact?
Well, you heard it from Justin Trudeau himself. Real consequences for the American people. It shows up like this, Tom, in some of the goods that are right behind me. Let me walk you through it. Fruits and vegetables. Most of Mexico's avocados are find a home in the United States. The majority of fruits and vegetables, about 47%, come from just Mexico and Canada alone when it comes to the American grocery list. On top of that, beer and tequila is a big one. So you're already see companies like Diageo, for example, really impacted at the European Open as well. Car parts is a big piece of it. This is where the world's car makers like to assemble their cars in Mexico and in Canada as well. Remember, they have that proximity to Detroit, the northern part, and really the Rust Belt of the United States. You've got the likes of lumber out of Canada, even steel, which is due to benefit, even in the short term, Tom. These are all things that are going to hit American pocketbooks.
OK, and what about the impact on the U.S. economy? What are the assessments right now, Kriti, in terms of the economic impact on the U.S. of these tariffs?
Well, one of the immediate question marks here was that even though this could have an increased kind of effect in the short term, some folks calling for a recession within weeks for Canada and Mexico. For the United States, it's going to show up in the form of inflation. This is what I mean by pocketbooks really getting hit. They're talking about a $930 drop in household incomes as soon as next year, within the next 12 months alone, if these tariffs stand as is. Inflation potentially up to 3%, certainly above that 2% level that the Federal Reserve likes to look at. So when we're talking about pricing in an uptick in inflation, these are the kind of things we're watching. We're also talking about core inflation. Remember, energy prices and, of course, food prices are going to be part of that core bucket, higher by 0.7%, according to Bloomberg Economics. Even U.S. GDP by 2029, by the end of Donald Trump's second term, a hit of $55 billion. And that's just one-sided. Remember, on the campaign trail, Donald Trump made a key promise that these tariffs are going to help really offset some of the tax cuts for American citizens. You penalize the rest of the countries for benefit at home. Well, that's how those tax cuts cost as much as $5 trillion. Those are the estimates, at least, in terms of the next decade. So you can see how maybe the $1.5 trillion estimated by the Committee for Responsible Federal Budget could potentially offset those $5 trillion. And, Tom, this is just the opening salvo. We'll see if there's more tariffs down the pike.
Yeah, promising to hit Europe with tariffs, of course. Just the opening salvo. Opening trade anchor Kriti Gupta breaking down the impact. Thank you. President Trump then also reiterating, as I mentioned, that he does plan to impose tariffs on the EU, saying it's definitely going to happen, citing a large trade deficit with the bloc.
It will definitely happen with the European Union, I can tell you that, because they've really taken advantage of us. And, you know, we have over a $300 billion deficit. I wouldn't say there's a timeline, but it's going to be pretty soon.
Let's bring in Bloomberg's Oliver Crook, who is in Hamburg. Ollie, how seriously is the EU now taking the threat of US tariffs, and what options could they reach for?
Yeah, Tom, I mean, I think they're taking it very, very seriously at this point. I mean, there were a lot of issues that the European politicians thought were kind of dead issues. I mean, I remember speaking to the Prime Minister of Denmark just a few months before the election. I asked about Greenland, and she kind of shrugged it off and said this is sort of a joke. I think we've said enough on this. It is clear that this is going to be a major feature of the Trump administration. And for European leaders, for the most part, they have been very sort of reticent to say anything negative about Trump. It's been sort of appeasement and being very sort of nice and that sort of thing. But they've got a list of retaliatory measures that they're ready to lock and load and fire off if they, in fact, get these sort of measures from Donald Trump coming in the next, we don't know, maybe days, weeks from the Trump administration. The question is, what are his demands in order to appease? What can the EU do to avoid getting these tariffs? He has made some indication of that before, Tom. He said that basically you need to buy more fossil fuels and LNG. You need to up your defense spending, presumably spend that money with U.S. defense companies. He wants to see NATO spending hit 5%. No country is close to that except for Poland, which will hit about 4.5%. 5.7% this year. But again, also LNG and the fossil fuels. If you're adding all these tariffs on Canadian imports to the United States, is there as much fossil fuel to go around sort of liberally to Europe is a major question. And Tom, just to put this into sort of the scale for everybody, the trade between the United States and the EU is about 1.5 trillion euros every year. That is bigger than every single European economy except for sort of UK, France, Germany, and Italy. And they enjoy right now 3% tariff. So if you were to see that go up to, say, 10%, Goldman Sachs has estimated that could wipe off 1 percentage point off of European growth. That is absolutely huge. And it's all to sort of adjust that trade deficit that the United States sees, particularly on goods. But let's not forget, actually, the U.S. runs a surplus of about 100 billion on services. So could that be another place that they could hit back? I mean, again, these are all just massive questions for the European economy, but they are dead center in the sort of sights right now, and it'll have a major impact on Europe.
Which parts then of the European economy is most likely or are most likely to be impacted? Where is the pain going to be faced and felt most acutely, Ollie?
Yeah, Tom, not to talk my book or anything, but it's basically Germany, right? About half of that surplus, more than half of that surplus that Europe runs with the United States is with Germany. They run a surplus of about 85 billion euros in trade surplus with the United States. And now the United States is the biggest trading partner of Germany. They pivoted away from China as part of the China de-risking strategy, and they moved straight to the United States. They are going to get absolutely crushed by this. And I'm sitting here in Hamburg. You can't see it right now out the window right next to me because it's still dark out. This is the biggest port in Germany. This is where all of the sort of major trade happens within Germany. Comes into this port. This has been a port that has been operational since 1189 AD, right? So this has been a sort of hub for European trade for a very long time. And let's not forget, Tom, this idea of global trade and exporting to the rest of the world has been the catalyst that has created this huge amount of growth within the German economy for the last few decades. That is currently drastically at risk. We have some estimates from IFO saying that basically these tariffs could reduce exports from Germany into the United States by 15%. It could hit the automotive sector by more than 30%, pharma more than 30%. This is an economy that has basically built its entire economic legacy on open trade. If you start to crush that, particularly after the data we got last week, we have inflation in Germany at about 3%, another contraction. What you're basically going to guarantee this year for Germany is another year of contraction. That will mean 3 years of consecutive contraction. Tom, that has not happened once since the Berlin Wall fell in 1989. So this is an absolutely huge sort of development for the German economy, particularly in the throes of what we can call a very chaotic election period and not really a sort of a cohesive narrative for how Germany can respond and really turn its economy around.
OK, Bloomberg's Oliver Crook in Hamburg on the fact that Germany is at the tippy point edge of this potential impact of tariffs that, of course, Donald Trump has said he promises on the EU after hitting Canada, Mexico and China. The context and the details in terms of the potential impact from Oliver Crook on the ground for us in Hamburg. And, of course, with German elections just a couple of weeks ago away, we're going to have a special focus on how our new Chancellor may navigate the trade and tariffs challenge. Oliver Crook will be live from the Port of Hamburg, speaking with guests, including the CEO of Hapag-Lloyd. That is tomorrow on Bloomberg TV. So tune in for that. Even more important in light of these tariff threats, of course. A line crossing just in the last few minutes around Samsung's leader, J.Y. Lee, winning an appeal case. This relates to a merger dating back to 2015, an $8 billion merger. The Seoul High Court has upheld an acquittal of Samsung's executive chairman, J.Y. Lee. So that line crossing just in the last few minutes. Samsung Electronics currently down 2.7%. That may be more of an effect and reaction, of course, to the tariff risk. Now, emerging market currencies have slumped on the back of those tariff announcements, with the Mexican peso and South African rand the biggest losers. Let's check in on how the markets are positioning. Mark Cranfield from Bloomberg MLive's team joins us from Singapore. Mark, I know you've been watching as well and monitoring the impact across the US Treasury curve. It's difficult to know which asset class to zoom in on right now because the moves are pretty extreme. Talk to us about what you're seeing. What stands out to you in terms of how the markets are adjusting to this news?
Well, it's the macro traders which are in control so far today, and that's not too surprising because we haven't got the US cash markets and the European cash markets still haven't opened. So we have to take into account what we've seen so far in Asia. And what you have, obviously, as you say, US dollar is extremely strong, pretty much across the board. Some divergence with the Chinese yuan, as everyone was saying. Suspicion of stealth intervention already to try and keep the yuan a little bit stable. And that's certainly the genesis of a Wall Street Journal article which has been going around suggesting they're preparing talks with the United States. But if you look at the Treasury curve, what's interesting there is that the short end is looking at the inflation impact from tariff. We've got higher yields in the short end, especially the 2 years, which is very sensitive to what foreign exchange traders do. So that's partly where the US dollar bid is coming from, apart from the obvious headlines about tariffs themselves. But if you look at the very long end of the yield curve, we're seeing much more demand, particularly around the 30-year sector, and that suggests that people do think that the growth factor is going to be affected in the United States. Bloomberg Economics reckons more than 1% will be shaved off US GDP this year if the tariffs stay in place for the rest of this period. And that's what people are thinking, is that, yes, even though the US is trying to isolate itself, it's trying to put America first, it will have a contractionary impact on the US economy. That's why there's a lot of demand for the longest US bonds. We haven't seen that for some time, where the curve is inverting, or not inverting, but the long end is outperforming dramatically compared to the short end. That may well develop further during US trading. And then, of course, people want to see the inside story of the US equity picture. At the moment, it's just a sell across the board, but we might start to see a lot more divergence within sectors as people in the US start to react to what's happening in Canada, Mexico, and other places as well. It's going to be a very interesting day in the US. Picture could look quite different by the time Asian traders come back tomorrow.
Yeah, as you say, that divergence between the 2s and the 10s and the 30s as well, stateside, is pronounced, isn't it? Mark Cranfield from Bloomberg MLive's team in terms of what to watch, what to monitor, in terms of the market reaction to this news and that potential more than 1% hit to the US economy itself. Let's get you the details right now on an earnings story coming through from the Swiss giant in terms of wealth management, which is Julius Baer. This is a focus on cost cutting. They've cut the executive board to 5 members. There's a key line in terms of net inflows for the full year. Julius Baer net inflows coming in above the estimates at 14.2 billion Swiss francs. That is one of the key lines. The full year dividend per share seen at 2 Swiss francs 60. That is slightly below the estimates. We know how there has been scrutiny in terms of the return of cash to shareholders as well. A new CEO, of course, at the head of Julius Baer, recently appointed just in the last couple of weeks. But that's the red head across the terminal right now. Julius Baer cutting the executive board to 5 members. We will watch that stock, of course, at the open as well. Coming up, Donald Trump threatens to cut off aid to South Africa, sparking a sell-off in the rand. We have the details next. This is Bloomberg. Welcome back. Now, Donald Trump says the US is to stop sending aid to South Africa over its land expropriation policies. The US president's comments come less than 2 weeks after Cyril Ramaphosa's government signed a new law making it easier for the state to expropriate land subject to equitable compensation. Our Africa correspondent, Jennifer Zabasaja, joins us now from Cape Town. Jen, just explain to us, for those who are not familiar with the details of this, what is driving this decision from Donald Trump? What is the context? What is behind his animus when it comes to South Africa's recent policies?
Right. Tom, good morning to you. It's really quite fascinating, and the timing of this as well, because as you mentioned, this was something signed by President Cyril Ramaphosa just 2 weeks ago. It caused a bit of division depending on who you spoke to. And in particular, we have this government of national unity, some of which say this was just a revision and an update to a law that was back in 1975. But other people are saying this is really going against what this country stands for. So, yes, as you mentioned, this is expropriation without compensation, but the details are important here. And what the government says is a lot of these lands, if they are to be seized by the government, they are largely going to be abandoned buildings. And so, yes, we're now hearing President Trump taking aim at this. We should note that one of his closest advisors, Elon Musk, was born in South Africa. Potentially, that is something that he has thought about. But this could be significant for the country. You mentioned that the rand rand was tanking. We've actually seen it weaken against the dollar. Not just that, we're looking at aid over the past 2 decades that's been upwards of $8 billion. So this could be significant for the country, not something that Cyril Ramaphosa necessarily wants to hear. We're actually hearing from South Africa's foreign minister specifically about this and saying that the Expropriation Act is not exceptional, as many other countries have similar legislation. And he's saying that hopefully the U.S. uses this time instead to investigate and look into what this law is actually doing before acting too quick. But yes, a bit of trumping a lot of the news that we're focused on here is the potential for this rescinded aid and also the tariffs, Tom.
Yeah, and of course, a big chunk of that aid apparently reportedly going to South Africa's continuing and ongoing fight against HIV as well. So the potential human impact is there. Look, you're on the ground, of course, Jen, at the African Mining Indaba conference. What is the reaction there on the ground when we weigh up, of course, the commodity space and the reaction amongst leaders within the minerals and commodities and mining space to these tariffs?
Yeah, I mean, Tom, prior to this announcement overnight, there was already a hanging concern about what a global trade war would mean for global commodity prices, right? And this is coming at a time where a lot of African countries and companies are really trying to get more value add when it comes to mining. And so this is not something that they necessarily want to hear, because this is going to essentially affect what it is that they're able to benefit from the actual extraction and downstream process. And so, yes, you can expect it's going to be a lot of the discussion around here, and potentially even will heighten what we do hear from countries, many of which have already tried to rewrite some of the code around these mining deals. They're going to factor in what we're seeing with prices and how that could affect long-term agreements.
OK, Africa correspondent Jennifer Dabasaja on the ground for us, and of course covering that event with executive reaction within the mining space to the threat of this global trade war potentially. Elon Musk, meanwhile, has been talking about what's happening with DOGE and his links to the Treasury Department. That is a really important story, cutting off some flows and some payments via the Treasury Department, and a number of senior Treasury officials, of course, have resigned. Coming up, as President Trump vows to drill, baby, drill, what does US policy mean for the oil refining sector? We'll discuss that next. This is Bloomberg. Oil jumping as President Trump placing heavy tariffs on a range of imports. Of course, those tariffs to kick in on Tuesday, including crude from Canada and Mexico, threatening higher costs for American consumers. Crude had fallen since Trump's inauguration, with the new administration's policies threatening to disrupt global trade and growth. So what does all of this mean for oil refiners as we look at WTI, currently up 1.9% at 73.93. Here to tell us more is Claudia Lubis, an associate in Bloomberg NES oil team. Talk us through the Trump impact then.
Thanks, Tom. And yeah, these tariffs are likely going to be an impact for U.S. refineries. Now, Canada especially accounted for over 60% of U.S. crude imports into the U.S. in 2024. And is the sole crude importer into the Midwest and Rocky Mountain districts. Refiners in these areas are not only attuned to taking in the heavier and cheaper Canadian crude, meaning it's going to be inefficient and also not cost competitive to just run the light U.S. oil, but at the same time face the lack of alternatives given that these regions are landlocked and also only have a couple of large pipelines running through them. And so as a result, fuel makers in the area may need to lower their run rates potentially, or face higher costs to source their feedstocks, which may eventually trickle down to higher prices at the pump for American drivers.
OK, that's really interesting. And so that's why they can't just switch up to the lighter, sweeter crude that is produced in the US market. It's not as simple as that. It's the impact on refiners, particularly in the Midwest of the US, on these 10% tariffs on Canadian exports of oil. Claudia Lubis, an associate in Bloomberg NEF's oil team with the context. Coming up, President Trump reiterates his threat to impose tariffs on the EU. We walk through the economic impact on the Eurozone. That's next. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. US and European futures plummet. The dollar surges after President Donald Trump imposes tariffs on Canada, Mexico and China, threatening to upend global trade. Canada and Mexico vowed to hit back with countermeasures. Beijing is reportedly preparing a US trade proposal to avoid further tariffs. And the euro slides as Donald Trump says the EU is next, threatening tariffs very soon. So the clock is counting down to those US tariffs kicking in. The signature of President Donald Trump is on the order. The implementation of those tariffs will take place on Tuesday. As things stand, he'll have a call for the leaders of both Canada and Mexico before we get to that point. European stock futures currently taking a huge hit. You're set for some bloodletting across European stocks today. It is a risk off across these markets, currently set for a loss of 2.4% so far. FTSE 100 futures here in the UK with a focus on miners and the impact there, with copper prices lower, currently pointing lower by 1.3%, though oil is higher, of course. So watch the energy producers as well. S&P futures currently pointing down by 117 points, looking to drop 2% on the S&P 500. NASDAQ 100 futures set for a fall of almost 2.5%. Let's flip the board and have a look at the FX impact. The dollar is surging, euro under pressure, the pound under pressure, and we'll get to the Mexican peso and the Canadian dollar shortly. 102 on euro dollar, down 1.1%. Yields are up at the front end on the Treasury curve, down on the lower end. There's a bid towards the back end, 10-year and 30-year a bid. The front end is being sold on and off on expectations the Fed will have to keep rates on hold for longer. 4.23 right now on the US 2-year, yields up 4 basis points. NYMEX crude, WTI, currently jumping 2% higher. There's a 10% tariff coming through on Canadian oil, 4 million barrels per day into the US market from Canada. Bitcoin also taking a knock at 94,000, down 2.5%. Let's check in on the Mexican peso and the Canadian dollar. The Canadian dollar falling to its lowest level since around 2003. Let's flip the board and have a look at the FX impact then, particularly on emerging markets, but also with Canada in focus as well. So the Mexican peso down 2% versus the US dollar. There's the Canadian dollar in focus for us, falling 1.2% at 147. The offshore yuan also a little softer, down 0.2%, but maybe some intervention coming through from officials in China. We monitor these currencies, of course, throughout the day on the tariff impact. More now on President Trump's threat to impose tariffs on the European Union. I'm joined by Melanie Debono, Senior Europe Economist at Pantheon Macroeconomics. Melanie, before I get to the theoretical proposition of tariffs on the EU, I want to ask about the second derivative effects on Europe of tariffs that we know are coming, in all likelihood, by Tuesday on Canada, Mexico and China. What is the impact on Europe of those tariffs?
The impact on the EU from the tariffs on China, Canada and Mexico are very limited at this point. The proximity of those countries, namely Canada and Mexico, of course, means that they export a lot to the US and they export different items than the EU does to the US. So, a blip.
And how should we think about the rerouting of global trade longer term? If these tariffs are held in place, just 25% on Canada, Mexico and 10% on China. If we just think about those tariffs for now and what that does to the global trading infrastructure and how trade flows are rerouted around Europe on the back of that.
Well, if the EU is put under tariffs which are lower than these countries, then the EU would benefit from some rerouting. But to the extent that if Trump comes out with exactly the same tariffs on the EU, then potentially there wouldn't be any impact.
What is your economic forecast for the Eurozone on 25% tariffs? What have you baked in? What have you priced in terms of the tariff impact on the Eurozone economy that we know is stagnating or flatlining?
So our baseline currently includes a 10 to 15% tariff on the EU. And in that respect, we think that the hit to exports and investment would be quite small. If Trump comes out and puts a higher 25% or 30% tariff, then the hit to exports and investment would be bigger. Of course, there's plenty mitigating factors, rerouting being one of them at that point, but also retaliation. And we have to also consider that there are some goods for which U.S. substitutes just won't do. So U.S. consumers won't stop consuming European goods just because they're more expensive.
Is the impact primarily for Europe going to be on growth or inflation?
Well, Depends. So it really depends exactly what the rate of the tariff that we get is, whether or not it's a tariff, a blanket tariff, or whether or not it's concentrated on a few goods, or whether or not it's a blanket tariff increase. So if anything is currently 20%, if that increases to 30%, or if everything is tariffed at 20%. The inflationary impact will also be dependent on any issues relating to supply chain costs. So, of course, the tariffs on China could mean that there are some supply cost increases, and also whatever has increased in price in the US, if it's an input into EU goods, will also have an impact there. It's also, of course, a big question for the ECB to answer.
What is your level of confidence that the progress that Europe has made on inflation is not derailed by tariffs? And of course, you talked about the different scenarios under which tariffs could impact Europe and the size and scope of those tariffs. What is your level of confidence that the progress on inflation continues for the ECB?
If our baseline is correct and it's a 10 to 15% tariff that's imposed on the EU, then our forecast is that inflation, which will fall in the near term and then increase, will probably stay as is. So we've got inflation falling to 2% in February and then rising again to 2.5 to 3% later in the year. Anything higher than that, the impact could be bigger, but again, really depends on which goods the tariffs are imposed on.
So much uncertainty, isn't
exactly.
there? So markets are currently pricing at about 84 basis points in terms of cuts, additional cuts to come through from the European Central Bank. Let's stick with your scenario around 10 to 15% tariffs on Europe. Is 84 basis points, 80 plus basis, is it too much, too little? Do they need to do more? What are you factoring in terms of the ECB's reaction function to that?
So our current forecasts have 2 more rate cuts at this point. So for a total of 50 basis points of cuts, taking the deposit rate down to 2.25%. And that will be a cut in March and a cut in June.
And that's assuming 10 to 15% tariffs?
That's assuming 10 to 50% tariffs. Anything more, again, it's for the ECB to decide whether or not it is net inflationary or net deflationary, whether the hit to growth will be so big that actually inflation will come down quicker than what we expect, in which case then they'll have to ease more. But at the moment, we think markets are overdoing it. And actually, given where we think the neutral rate is, which, of course, the ECB is dodging all the questions on the neutral rate, and where we think it will stop, we think that we're probably actually on the good side of the...
OK. No, but that's really interesting, that call on 50 basis points of additional cuts. And that factors in a 10 to 15% tariff impact. Are we underestimating the read across from the Fed that may be held on pause for longer, and what that impact is on the ECB and the BOE here in the UK of a higher for longer Fed?
Well, again, our forecasts have higher for longer compared to where markets and the consensus expect. We do not think that the ECB will be rattled if the Fed stops or if the Fed goes quicker. It's said in the past it is going to go down the route, remain data dependent, meeting by meeting approach, not looking at what others are doing. Of course, it can't completely ignore it because any impact on the euro could have an impact on the inflation, but we don't think it will be watching exactly what the others are doing very closely. Do
you have a kind of risk radar in terms of the sectors, or at least the segments of Europe's economy that are most vulnerable to US tariffs? What kind of stands out to you right now as the weak links when it comes to Europe's economy on the impact of tariffs?
I mean, at this point, we think that if the U.S. administration were to have to target different sectors, it would probably do the same as it did in 2018, 2019, and go down the route of aluminium and steel. Cars, of course, are the main competition that we've been mentioning. But perhaps there'll be negotiations. We've already heard from Donald Trump that if the EU imports more of U.S. gas, then maybe they won't get tariffs. So it's all up in the air. OK, and we know the EU is planning to import more, certainly plans to import more more US gas, of course, to fill the inventory gap. Melanie Debono, senior Europe economist at Pantheon Macroeconomics, with the potential economic impacts on the Eurozone, factoring in there a base case of around 10 to 15% tariffs. And we'll see, of course, what actually comes to pass. Now, we have some lines crossing in terms of L'Oréal to sell around 29, so close to 30 million shares in Sanofi, to Sanofi for €101 per share. That's a line crossing in terms of L'Oréal selling some of its shares in Sanofi. So that is another stock for you to watch at the open, 8 a.m. UK time. Now, some other stories making the news this Monday. Elon Musk says his Department of Government Efficiency is in the process of trying to, quote, shut down US aid.
The US aid agency's website went offline over the weekend as the Trump administration reviews its future. Sources say some officials at USAID were also placed on leave after denying staff from Musk's Department of Government Efficiency access to systems, citing lack of security clearances. Musk also says his DOGE team is shutting down some payments to federal contractors, suggesting he may have access to sensitive systems used at the US Treasury Department. President Trump has put the Tesla CEO in charge of modernizing federal IT, but Musk appears to be expanding that to mandate to include control over financial flows in other parts of the government. UniCredit has made a surprise new move in the fight to dominate the Italian financial system by unveiling a minority stake in insurance giant Generali. The Milan-based bank says its 4.1% stake in Generali is a pure financial investment with no strategic interest in the insurer. According to our sources, UniCredit began accumulating the stake in September, some months before its bid for Banco BPM. And we're going to have an exclusive interview with the CEO of Generali, Philippe Donnet, on The Pulse with Francine Lacroix. So tune in for that interview. Coming up, we continue our coverage, of course, of Donald Trump's move to impose tariffs on Canada, Mexico and China as businesses and investors brace for the fallout. Stay with us. This is Bloomberg. Now, after weeks of threats, a North American trade war has erupted. President Trump warning the world that trade tariffs were coming, and now their impact is reverberating across global markets. It is the most extensive act of protectionism taken by a US president in almost a century, and it swings a wrecking ball through the alliance between the US, Canada, and Mexico. Let's discuss the implications with Brendan Murray, who leads Bloomberg's global trade coverage. Brendan, thank you for taking the time. Top line, what is the impact on the global economy and supply chains from these actions?
Well, it's going to be yet another shock to the system after a number of them over the past several years, from COVID to the attacks in the Red Sea to the war in Ukraine. One by one, these shocks to keeping stability in global trade are gonna create problems anywhere from raising costs of imports or exports to shipping delays and all sorts of other things. When the system has stress on it, it has very little flexibility to absorb that. So we will see this ripple effect, not just from the, Canada, U.S., Mexico dispute, that it could extend to China and to the European Union as well. So global trade is very durable. It held up pretty well throughout the past 6 or 7 years. But this one is really going to test the fundamental principle of the free flow of goods around the world.
Do we know, Brendan, at this point, where the heaviest cost will lie? Whether it's the importers, whether it's the producers who absorb that cost, whether it's consumers? What is the spread of impact from these higher taxes on goods produced in Canada, produced in Mexico?
Yeah, I mean, there's a whole industry of in logistics, and their customs brokers and their freight forwarders, and they're sort of the middlemen between the company that buys a good and the company that makes a good. And it's in the middle of that system that someone's going to have to pay that higher 20% tariff or that higher 10% tariff in China's case. And I saw some notes yesterday from companies saying we're going to have to increase the customs bond that we have. It's going to all of those goods coming that we ordered a week ago. They're going to come across the border this week, and there's 25% more expensive. So there's going to be strains in the system where the money changed hands, and some confusion about who's going to pay that initially. And by a lot of the reporting that we've done already, those costs are just going to get passed along. The customs broker is not going to take the full burden of that. So it works its way through, and ultimately consumers face the higher costs that are coming.
Brendan, is the auto sector the sector that stands out to you? There was a quote from our Bloomberg team in terms of the Economist's team, their analysis, their line standing out that essentially these tariffs are a tariff on the US auto industry itself because of the connectivity between the US, Canada and Mexico when it comes to the auto sector?
Yeah, exactly. And when we think of the auto industry in North America, I think we think of, the big auto companies, GM, Ford, the household names. But the auto industry is this incredibly complex system of suppliers, multiple tiers of suppliers, and that employ hundreds of thousands of people, and they depend on each other to to deliver the parts when they're needed, and gumming up that system can really slow everything down. I saw a quote from a Canadian Auto Industry Association saying the Canadian auto industry is going to shut down next week if this is the case. It will cause a lot of disruption, add costs, and if there is not some sort of negotiation soon to end it, the economic pain compounds on itself, and it's harder to dig out of.
What do we make of the decision to put 10% tariffs on China, 25% on Mexico and Canada, 10% on China? What does that signal about the way the Trump administration is thinking about its trading relationship with the world's second largest economy?
It signals that he probably wants to take these confrontations in stages, and that the North American one is the one he's going to address now because of the drugs and the migration issue he wants to deal with on the northern and southern borders. China, it was curious that he only put 10%. He put 25% on our friends, 10% on a strategic adversary, and it told me that he hasn't forgotten about China, but the real showdown with them is sometime off in the future.
OK, Bloomberg's Brendan Murray, really appreciate it. Our global trade czar on the global impact of these tariffs, of course, that will be implied and put in place, at least implemented, come Tuesday. That is the expectation. Thank you. Now, Panama has promised free passage for US warships through the Panama Canal and said it will withdraw from China's signature lending program. This after Secretary of State Marco Rubio blasted the government during his visit over the weekend, calling Beijing's influence in the region unacceptable. There is plenty more coming up. Stay with us. This is Bloomberg.
If we have tit-for-tat retaliation, whether it's 25%, tariff 60%.
All we know for sure is that it will have a global negative impact.
In the US, you put on tariffs, these things can be inflationary.
The tariffs is not really the tool to deal with economic security considerations.
It's far more complicated than it's this way or this way. It's inflationary or deflationary.
The only thing I can say, there are losers on both sides.
There could be a moment where, given the high level of government debt, that the investors suddenly decide, you know what, we want a much higher coupon to lend to, to governments.
We're going to see double-digit global GDP losses. Double-digit. That's catastrophic. Everyone will pay. Everyone.
Policymakers and CEOs reacting to the threat of US tariffs on Europe and the global economy. These warnings, of course, coming before Trump's announcement that tariffs on Canada, Mexico and China will begin tomorrow. 25% on Canada, 25% on Mexico, 10% on China, with a carve-out for oil of 10% when it comes to Canada. WTI, though, is popping because you have, of course, 4 million barrels per day being sent and transported from the Canadian market into the US market. In fact, you've got a divergence in terms of the pricing coming through for WTI. There's the pop on the back of these tariffs. The divergence between WTI pricing and Brent, of course. The pop is there, higher prices. For how long, one has to question if this erodes the global economy, slower growth, less demand for oil. But right now, oil prices are surging on the back of this news. Let's flip the board and have a look at the imports then. So around 4 million barrels per day from Canada, around 500,000 per day from Mexico. Again, amongst the top two trading partners overall. And this in terms of what is coming through on the oil front. Canada stands out, of course. There's the refiners in the Midwest. They cannot switch up to the light sweet crude of the US. They are built, those refiners, to take the dirtier, cheap oil from Canada. They do not have other sources they can reach for. And that will be the pain point in terms of the Midwest of the US on this, and potentially inflationary for consumers at the pump. Let's flip the board and have a look at the most exposed European stocks to the tariff impact, because that impact is certainly there. And front and centre is the auto sector. Stellantis, VW, Mercedes, BMW, one of its biggest plants, if not the biggest, of course, is in the US, but they depend on the flow of autos parts from Canada, from Mexico. So watch the automakers at the open at 8 a.m. And then in terms of Mexico, the Spanish lenders, BBVA, Santander, Iberdrola, all in focus as well. The alcohol makers could be impacted. The miners, we're seeing copper down. Oil is up, so watch the energy producers. But in terms of the miners, particularly on the FTSE 100, that could be the pain point. Rio, Glencore and Anglo-American. And then on oil, on higher prices, we watch Shell, BP and Total Energy. In terms of breaking lines coming through from the wealth manager Julius Baer, we knew there was a focus on cost cuts. We knew there would be a focus on the board. They've shrunk the board to 5. They are looking to cut around 400 jobs in Switzerland. This Julius Baer line crossing just in the last few minutes. There's the red head across the terminal. Stock is up around 40% in the last 12 months. That is a stock to watch as well. Coming up after 9 a.m, we're going to have an exclusive interview with the CEO of Generali, Philippe Donnet, on the pulse with Francine Lacroix. Really interesting, of course, in the light of that UBS, or Unicredit, I should say, Unicredit building out a 4.2% stake in Generali. So stay tuned for that interview. But before that, it's the opening trade with the breakdown and the market reaction to the tariff story. That is coming up next. This is Bloomberg.